GM and welcome back to the channel. I'm Gareth, aka CryptoTube across socials with a Blockmates breakdown here of Bumper Finance. We're going to give you the TLDR on this one and also take you through the Dapp itself so you can see exactly how this will work and how you can use this for your own risk management. Now, as ever, make sure you subscribe to the channel if you're new here. Drop us a comment down below and let's jump in. So Bumper Finance here is a pure DeFi risk management tool. No KYC, no AML, none of that good stuff, just you interacting with smart contracts. Now this allows you to bumper your crypto assets and protect them from a price crash. So by bumpering your assets, you protect it with a price floor. Sounds pretty cool, doesn't it? Maybe you can then take a vacation without having any stresses or worries. And Bumper is cheaper than using options protocols, making it a lot more efficient and also more easy to understand than options. Plus it's more beneficial than setting a stop loss, as I'll go into in just a second. Now there's two sides of the coin here. You have the takers, those looking to protect their assets, i.e. holders of ETH. And then on the other side, we have the makers, those making the market, providing USDC liquidity. These are the guys that will be earning that sweet real yield. So let's go ahead and break this down a bit further. On screen are some examples of what happens when you bumper your assets. So say you've got some ETH and you want to bumper that ETH and protect it with a price floor. Well, first off, let's just think about other methods. You could use a stop loss on a centralized exchange, but as we know, and you've probably already experienced, there's many frustrations with that. Stop loss not triggered being one, and also the lovely situation of having your stops hunted. You meticulously place your stops, and then the market maker runs those stops and price rebounds directly afterwards. It's up like 10-20% and you're left seething. But instead, if you want to bumper your assets here with Bumper Finance, you can see the following is applicable. So on this diagram here, say the price goes up during the period of your coverage. This is the start point, this is the end point. Now during this period, even if the price does come below the orange, which is your floor price, you're not selling the asset. It's only until this duration has expired that your policy actually kicks in. So during this period, you're not selling out your asset. You're not leaving those potential gains on the table here. You still get the upside of holding that ETH. You've just bumpered it and protected it during this period of volatility. Then at the end of the period, you get your ETH back. Now also on the right-hand side, if the price does go down during this period, you can see it does drop below your floor price here, the orange line. Well, in this situation, the value of your wallet is still protected. And at the end of the term, you will get stablecoins back. Those stablecoins will equate to the amount, the floor price that you've put in for your assets. So you can see how the taker side of things, those who wish to protect their assets, works out here. We'll go into a bit more deep dive in just a second. But on the other side of the coin, we have the market makers, those who are placing down USDC into the liquidity pools to ensure there is coverage for those who wish to take out a protection policy and bumper their assets. Now, a bit of market data here as well. On average, Bumper users earn higher yields than compared to sellers of put options with similar strike and expiries on other crypto options platforms. These market makers choose the parameters, how many USDC do they wish to deposit into the contract, for what duration and what risk tier do they want to take on as well. The higher the risk, the higher the potential reward, as you can see from the ROI to the right hand side here. But that additional risk does have some factors. We'll go into liquidations at a later stage in the video. And you're probably also thinking, is this cost efficient for people to actually utilize Bumper? Well, looking at some market data, Bumper works out to be around 10% cheaper than a centralized competitor like Deribit. And also versus a decentralized competitor, it's coming out at around 50% of the cost of those others. So what we're likely to find is that the alpha hunters in the market will come to Bumper because when there's dollars on the line, people choose the most efficient protocols. So a quick high-level overview of the actual protocol here. So a nice diagram for us to get started with. As you can see, there's four pools in action here. We have the asset pool and the asset reserve. This is made up of ETH. And then on the right-hand side, we have the capital pool and capital reserve, USDC. On the left-hand side, we have the market takers, those wishing to protect their assets. And on the right hand side, we have the market makers, those providing the USDC liquidity and that floor protection for these guys over here. You'll also recognize there is a rebalancing going on down here as well. So the protocol does actually dynamically adjust the USDC and ETH in these various pools in order to meet its needs. This is a complexity you can read more about in the docs. But let's look at the two sides of a coin. So on the left hand side, we have the takers, the ones who want protection. So they come in here with their ETH and they deposit their ETH into the smart contract. This goes into the pool here. They will select what percentage of their ETH they wish to deposit. Maybe they'll put their full balance on their wallet in here, whilst of course maintaining some gas for gas costs. They'll also then select the duration of the coverage and also the floor price they wish to maintain for the asset. For utilizing this service, they pay a premium. This will be taken in ETH, and they will also pay a protocol fee as well. On the flip side, we have the makers over here. These guys have USDC. They bring that to the table, deposit it into the pool. They have to select the level of risk they want to take, as we saw in the previous diagram, plus the amount of USDC they wish to deposit and the duration also. Now the premiums paid from this side come over to the pot for these guys over here, and this is where that real yield is coming from in USDC. Now the gigabrains over at Bumper Finance have somewhere in the region of like 100 different parameters working out what premiums should be paid, and of course that corresponds to the yield being accrued by these guys. And so the pool of funds that makes up these different pots will reflect upon the premium being paid and the yield being received. And this will be dynamically adjusted to ensure that there is a good balance, a healthy balance between the two sides. So say there's high volatility in the markets, the premium being paid will have to go up to incentivize more users to actually bring their USDC in, since at that point in time with high volatility, it's probably less likely people are willing to risk their dollars. So this is very much gigabrain stuff from this team and a potential DeFi blue chip and primitive in the making here for risk management. So let's do a bit of a Dapp walkthrough here so we can get used to using the functionalities on here. As you can see, they have this very much aesthetic of the 80s kind of retro theme, which I absolutely love here. Shows they have a keen eye for design. And I think ultimately I do like it when protocols put a lot of effort into the appearance of their Dapp. Now this is very intuitive as well. We have on the left-hand side protect and on the right-hand side earn. So protectors, the ones with ETH, earners, the ones with USDC. And you can see I've had a bit of a test on here as well to play around with the Dapp and see how it feels. So let's actually just go through a policy here. So we're going to protect some ETH here. So what you want to do is click on the word protect just over here on the right hand side. You could obviously go into my current position here if you want to check that out. We can do that at the end, but I'm going to press the protect button here. So 3 stages here: details, the confirmation stage, and a summary. So it says protect. The Bumper protocol is designed to give you the ability to protect your assets from downside price movements. Now in here, we just got to fill out the drop down of options. So protection amount, enter the amount of your balance you wish to protect. So if I just press max on here, we can see what I've got left, 0.9 ETH, which is 100% of my portfolio. You can obviously toggle this down, bring it down by 1%. Maybe we'll just do say 95% for argument's sake on here. So 0.855 of an ETH, current value here, $13.78. So the protection floor is the next parameter. So we've got a sliding scale here for me to use. Do I want to protect this at an 80% floor? So 80% of 1378 would be 1289, the figure quoted in here. We can obviously notch that up a bit. It's kind of like, how much are you willing to lose here? What kind of protection do you want? If we do this at 90%, this is going to mean it's a more expensive protocol fee for us to take out. We've also got to put in the protection term in days, in multiples of 30 days. So 1 month, 2 month, 3 month, 4 month, or 5 months. So if we just do the 1 month here, we can watch how these dynamically change as a result. If we start to increase this from 30 days to a 60-day policy, if you watch the risk rating down there, it starts to come lower and lower and lower the longer the duration that we actually take out. And as we change the parameters about the protocol fee in dollars, that will adjust, and also the bump incentives will also adjust as well. And finally, also the required bonding amount also. So the longer that you actually go ahead and do a policy for, the lower the amount of bonded bump that is required. So as it says, these are just bonded for the duration of your policy. You're not actually spending them, but you have to hold them in your wallet, and they will no longer be spendable once bonded. And then at the end of the policy, you will get these bonded bump back. So if we're happy with the parameters, so what we've done is we've got a 90% price floor for 150 days, a long policy there. We can see the various amounts we need to bond, the actual fees that are being charged, and the incentives on top. As we are early adopters here, they are incentivizing users to obviously use the protocol. So we're going to make some money back from this in bump as well. And then we just need to go through to the confirmation stage. So we need to press the next button here. The confirmation then breaks down all of the nitty-gritty details for us. So top line here, we're protecting 0.855 of an ETH. The floor price being set is at 90%. So that will be on the basis of 1 ETH being worth 1436. The protection term 150 days. So this will expire on the 1st of Feb 2024. And the bond, which we require in our wallet right now, is 324 bump tokens. Then the estimated incentive, 161 bump, will come back to us. And the protocol fee, as we saw earlier, tells you what it is in dollars, but it's taken in ETH from your actual total up here. That is 0.0423 of an ETH. There's also a note down here that the premiums are calculated at the end and thus deducted at the end of your policy. And these premiums are applied simultaneously to all protect positions, which is one of the main reasons why hedging here on Bumper is more price efficient than alternatives. So we're happy with the details being confirmed to us. We click the tick mark, approve our ETH in our wallet for spending, click next, and then pay the gas cost. Once that then confirms, click on the confirm button, and again, on-chain transaction in the wallet, DeFi at its finest, and this will go through once I pay that additional gas fee just by there. So there we have it. Protection is successfully done. All the policy details available for us, and this is stored as an NFT. Scrolling down to the bottom, you can see these are quite important. Add to calendar, a reminder of when your policy actually expires. And you can also set the expiry alert as well. You will definitely want to do that due to the fact at the end of the policy, you have 3 options: close, claim, or renew, and you need to follow that through. So back to the main Dapp here, back on Protect, you can see the 2 policies here. Now to go through those 3 options real quick. So at the end of these terms, we have the 3 options: close, claim, renew. So you would just come in and close your policy if the price of ETH is at or above the price at which you protected. This means you would then close out the policy and get your Ethereum back. However, if the price has gone down and your floor price is kicked in, you need to click claim. This will mean you can claim the USDC back at that floor protection price. Big thanks to those USDC market makers for that one. Or the third option, to renew and start up a new policy. But let's now click on the earn tab. So earn, this is where you can be a market maker and provide some USDC liquidity and get some very handsome rewards. So we're going to click on earn here. And the APR that you receive is very juicy indeed. That yield being derived from the other side here, no Ponzonomics involved. So it says you want to make some tasty moolah for providing liquidity, just deposit some stables. So I'm going to click on max here. We got 2,500 in stables. Choose the market, it's ETH and ETH only at this point in time. But I do believe they will have more assets coming online as time progresses. Then we have the duration to actually select. We're going to just go for a quick 30-day policy here. And the risk tier. So higher risk means higher reward, but you do put yourself in line for possible liquidation earlier if the protocol gets into some troubles. By sliding this up to the right, you're going to get in more danger there. So maybe we'll keep it in the middle ground here at a tier level 3. Again, for using both sides of the equation here, you have to bond some bump tokens. So that's saying around 618 bump. It's then spitting out the deposit value, $2,500. The yield rate, 4.37%. I believe this is per month, however. They'll also pay me some bump incentives down here, and the protocol fee is $24.75. So let's just run through this, click on next, go to the confirmation page here. We can see all the various details. 2,500 USDC for 30 days. Expires on the 4th of October 2023. You can see the incentives and again the protocol fee there, and that will be taken in dollars from my starting amount here. So if we're happy with that, we click on the T's and C's, give that a check and approve the USDC for spending. Click on next, and then we have to do the on-chain transaction. Once that happens, we click on confirm here, and then we have to confirm that with a signature and then an on-chain transaction yet again. A little bit of gas cost, and then we should be done. So again, we have a successful policy here on the earn side. We have all the details given to us and the ability to add this then as a reminder to our calendar as well. But let's just go back to the policy pages. We'll go into earn, and then we can see our two positions on here. If we just open up one of them here, show the details, you can see that the APR is per month. So 4.3% per month is actually what you're going to be getting out. On the earn side, this is a very juicy yield indeed. So 4.3% per month is the payout here. So as you can see, that is a very juicy yield indeed, and it is real yield paid out in USDC to you. And I think this highlights how beneficial this project can be from both sides of the equation for those who wish to protect their assets, but those who also wish to provide the liquidity for the protection side. Now, everything is not without risk. There are liquidations possible for both the takers and the makers. On the taker side, so those who wish to take out a policy, say they have a policy that expires and they don't do the claim, renew, or closing of the position, this renders the taker liable for an expired position penalty. And it says this will just continue to accrue if they don't withdraw. Then should the premiums and fees equal or exceed the value of the tokens, then someone can actually call a function to liquidate the taker's position. And in this case, they receive the bonded bump tokens and any incentives that were due to that taker. On the maker side, those with the USDC, they can also get liquidated in serious market volatility events. So it says if there's huge and sustained price drops in a protected asset, this can lead to liquidations. And those with the higher risk tolerance, so if you choose the higher risk tiers, i.e. 5, those are the guys that get liquidated before the lower tiers. So you would receive higher rewards than someone with a lower risk tier, but you would be liquidated first in adverse conditions. So finally, the bump token, you can see it on screen here. Market cap's around 7 million, circulating supply around 98 million of 250 at a max. And the bump token here is used for two purposes. As we saw, it's used to bond either on the taker or maker side, plus it's also a governance token for the bumper DAO. And within the protocol, we could also see that the bumper token is used as an incentivization tool to boost the participation on either side of the equation as and when needed. There is already talk around a V2 update, and within that, there's the potentiality for a staking module for the bump token. And this would be similar to the Aave risk module, where bump tokens that are staked are at risk. They provide a backstop for the protocol, but they are incentivized to do so. So do check out Bumper Finance. Check out all the links down below. Subscribe if you're new, and we'll see you again in the next one. Peace.